Just Rosner had also begun complaining to the Fed about subprime mortgage. By 2000, he had left his job at a mainstream Wall Street investment bank and joined a small independent research firm. Once a Hawke believer in the new subprime companies, he had become deeply critical of them. Companies he had invested his clients' money in had gone out of business. He had watched the lawsuit pile up over their semi-business practice. I unintentionally help kill my clients, he said today. I was so desperate. Rosner had a foreboding that went well belong that of most subprime critics. Gramlich worried about subprime lending because it took advantage of unsophisticated buyers and often cost people their homes. But Rosner saw that the linking of borrower and lender could have more far-reaching consequences. While connected in Washington, he began showing up at the Fed to express his concern. Fed officials would respond by saying that it wasn't their job to determine who should or shouldn't get a mortgage. I'd say, but it's the Fed's, the Fed's job to ensure that the system is stable, Rosner recalls. There were two essential reasons for Rosner first. The first was that his close reading of the data showed that most of this frenetic mortgage lending really had nothing to do with getting people into homes, since the vast majority of subprime loans were refinancings. That was true of the prime market as well. He calculated that the dollar volume of refinancing during the 1990s was 3.4 trillion, more than the entire volume of mortgage organization in the 1980s. A little notice Freddie Mac study noted that more than 75% of home owners who refinanced in the last 3 months of 2000 had taken out mortgage at least 5% higher than the ones they retired. They were using their homes as piggy banks. Refinancing offers the potential to increase the absolute debt burden of the average U.S. household without materially reducing other consumer debts, Rosner wrote at the time. Surely, he thought all this additional consumer debt was likely to end badly. The second reason for Rosner's fears was that he could also see from the data that fewer and fewer home buyers were putting down 30%, which had long been the standard to get a mortgage. By 1999, in fact, more than 50% of mortgages had down payments of less than 10%. Angelo Mosillo, who was becoming an increasingly prominent figure in the mortgage industry, believed passionately that big down payments prevent otherwise capable borrowers from being able to own a home. For much of his career, he had fought to be able to originate mortgages with little or no down payments, and mostly he had won. Wall Street, no regularity securitized loans with down payments of 10% or less, and even Fannie and Freddie were allowed to buy low down payments mortgage, although they required a private insurer to absorb some of the risk. But Rosner picked up on yet another little noticed study, this one by Fannie Mae, showing that low down payment loans triggered greater losses. But put simple, a home owner with little or no equity has little or no reason to maintain her obligation. Rosner wrote, having equity in one's home was much more than a barrier keeping people from buying a home. He came to believe it was the key to home ownership. Down payments more than any single thing meant that you were a home owner. On June 20, 29, 2001, Rosner published a research piece that summed up his thinking, entitled "A Home Without Equity is Just a Rental with Debt." No one seemed to take much notice. He was working from home one day when the phone rang. On the other end was an elderly man. "I just read your paper and want to discuss it with you, but I can't hear very well on the phone," he said. "Will you be able to sit down with me in person?" "Sure," Rosner responded politely. Are you in the city? I'm in Lexington, Massachusetts," the caller explained. Rosner, again being polite, said he'd call when he was next headed to Boston for meeting meetings and asked for the man's name. My name is Charles Kindleberger. Kindleberger. The Cayer replied. Kindleberger was the author of Manias, Panics, and Crashes, which document market crises throughout the age and was widely viewed as a classic. Rosner had long admired it. The next morning, Rosner flew to Boston and spent the day with Kindleberger, who was 91. Kindleberger told Rosner that if he published another edition of Manias, Panic, and Crashes, he would use A Home Without Equity as the final chapter. There was at least one bank regulator in Washington during this era who tried to do something to curb subprime lending abuses. Her name was Donna Tanyu, and from 1998 to 2001, she was the chair of the Federal Deposit Insurance Corporation. Her concern stemmed from the simple fact that subprime lenders were shutting down. When those lenders were banks, it was the FDIC, which insures deposits for the federal government, that had to pick up the pieces. Tanyu's solution, an obvious one really, was for the subprime companies to hold more capital against those loans. Subprime lenders, he said during one congressional hearing, are 20 times more likely than other banks to be on the agency's problem list and account for 6 of the last 11 failures. By late 2000, she went even further, arguing that banking regulator needed to sever the money chain that replenishes the capital of predatory lenders as allows them to stay in business. She was talking about Wall Street purchase and seguration to subprime loans. Patricia Alberto, an executive at JP Morgan, wrote a letter in protest. The regulatory agencies and the public, in their quest to eradicate predatory lending, have issued guidelines that have the effect of imposing a large portion of the responsibility for ferreting out and eliminating predatory lending by others. To the large banks in the industry, because they are in position to provide liquidity to the marketplace, she said. Well, yes, that was exactly what Tanyu was trying to do. When Tanyu testified before the House Banking Committee defending her plan to increase the capital that had to be held for subprime loans, Representative Caroline Maloney, a Democrat from New York replied bluntly, "I'm concerned that adopting any arbitrarily high capital standard for subprime lending will unnecessarily reduce the number of subprime lenders." In early 2001, the banking regulator did issue guidance requiring institutions with heavy concentration of subprime loans to hold more capital against those loans. But the definition of what constitutes subprime lending was vague, and guidance was only guidance which lender could adopt or ignore as they saw fit, depending on how zealously the regulator enforced it. No anti-predatory lending bill was ever passed. No strictures against most of the practice were ever enforced. No serious effort was ever made to make financial institutions pay more attention to the loans they were buying and securitizing. Yet, even the evidence, as weak as it was, met with a fierce storm of criticism. John Range, a new member of the FDIC board, told the American banker that the regulators were in the wrong and that we should have done it right the first time. He clarified that doing it right meant consulting with the banking industry. James Widgeron, who became the head of the Office of Thrift Supervision in late 2001, would later say of his agency, Our goal is to allow thrifts to operate with a wide breadth of freedom from regulatory instruction. A few years later, a picture was taken of Guillermo on Rage with the representatives of 3 banks lobbying groups. They were taking a chain saw to the red tape of excessive regulation. In 2005, Rage replaced Guillermo as the director of the OTS. And yet, even though the bank supervisor refused to take a step to curb subprime lending, the smarter ones, the Office of the Comptroller of the Currency in particular, also didn't want its institution to make these loans. Via the examination process, which isn't public, the OCC quickly started making life difficult for any national bank that had a big subprime business. Early on in August 2001, Bank of America announced it was selling its 96 subprime lending branches and its to 36 billions loans portfolio. 4 years later, in a decision that every bank noticed, the OCC forced Laredo National Bank in Texas to make restitution to every borrower who had gotten a loan without the bank taking care to adequately consider credit worthiness. OCC ran every national bank out of the business, says a former Treasury official. Admirable though this effort may have seemed, it was both problematic and a little perceived because the OCC's effort was not matched by the office the Thrift supervision. Thrift began grabbing the supreme market share the big banks were abandoning. Subprime lending also began to migrate into state-regulated institutions, where, as Gromlich once put it, federal regulators have no obvious way to monitor the lending behavior of independent mortgage companies. And one other thing, what the OCC forgot was that even if the big banks were no longer making the majority of subprime loans, those loans were still finding their way into the banking system. All the big banks were also in the securities business, and they were all making fortunes securitizing subprime loans originated by others. And big and small banks alike continued to all mortgage banked securities on their balance sheets. But no one, not the banking supervisors, nor the Securities and Exchange Commission, not the Federal Reserve, was bothering to track this. That risk was supposed to be won. Finish. Thank you.